Hi, this is Brandon Bischoff,
And Tom Harden here at Canterbury Investment Management.
and we're bringing you this week's Canterbury Market Update for the week of August 26th, 2019. And so, Tom, the market, which we're going to use the S&P 500 to talk about, is currently in transitional market state 6. It's been there for the past 15 days.
Right.
And this market state 6 was sort of caused by a spike in volatility, or the Canterbury Volatility Index, CVI. So volatility got real low, and it has since risen to where it is now, CVI 87.
Right, and this happens from time to time. We've seen it actually a few times over the last 2 or 3 years when the volatility gets extremely low, and I know Brandon's talked about this in the videos, where it's like squeezing down a spring, and once you get the volatility to a certain level, you'll begin to see a kind of a spike or a releasing of the spring. And we saw that big time on Friday, which was about 2.6% decline in the S&P 500. And we were already in a transitional environment before that, and that kind of confirms that the market right now is trading somewhat irrationally. And these are the types of characteristics we'll see before we could go into a more bearish kind of market. I'm not saying that that's going to happen, but these are the characteristics that we see before we go into bear markets.
Yeah, and let's talk about, the Russell 2000 index, right? So in a bull market, you kind of expect to see small caps, which is what the Russell 2000 index measures, kind of lead the generals. So the troops are out in front of the generals, and the big names are kind of lagging behind in a bull market run. And has that really been the case today?
Yeah, that's been the case really, where as the analogy goes, you like to have the troops out front, the generals directing the action in the back. Well, what's happened is the troops have retreated, and the Russell 2000 has been performing pretty poorly for quite some time. And it's really, the market's been carried by some of the larger cap stocks, and it's only a matter of time till those fall.
And so we can see that on this chart, where you have the relative strength index, which shows the Russell 2000's relative strength to the S&P 500. And you can see really since last October, that relative strength has been, kind of strongly declining, both through the up markets and the down markets.
Exactly. So Brandon, another thing that's been concerning is, as we see the market go up, it's going up on much lower volume, but when it goes down, it's higher volume. And an example could be, let's say that the market goes down 1% today, and the volume is 1 billion shares. And tomorrow goes back up 1%, but it goes up on 4 billion shares. So that means there's a lot more demand than supply. The up days are bigger volume days than the down days. Well, it's the opposite right now. Right now, if you look at the chart, you'll see that whenever the market begins to go up, you'll see a decrease in volume. And then as it goes down, you're seeing increasing volume.
Yeah, and it kind of shows there's a lot more conviction amongst the sellers than there is among the buyers.
Yeah, and that's been pretty consistent for a while now.
So as you see this W formation go between support and resistance, I think we're between 29.45 is the resistance, and the support's at like 28.20 or so.
Right.
You're seeing a lot more volume on those downward spikes than you are on the runs.
Yeah, and we're doing this video at about 3 o'clock. We slipped the volume. Seems like it's about a third or so as much as what it was on Friday. And today's appears to be an up day unless it closes off here in the next hour or so.
So that brings up, how do you navigate, kind of a transitional market environment? How do we go about doing that? And the Canterbury Portfolio Thermostat's an adaptive portfolio strategy. And the way we measure portfolio efficiency and how it is for the current market environment is our portfolio efficiency score. And there's 3 different things that go into that. It's the portfolio state, it's the volatility of the portfolio, and it's the portfolio's benefit of diversification. And so if we're looking at our portfolio state, well, the market's in a transitional, kind of market state. The securities we're holding within our portfolio actually create a bullish portfolio state 1. The volatility measures CVI 45. Keep in mind the market's volatility is about CVI 87. And then our benefit of diversification actually increased last week to help stabilize the portfolio. And that brings us to a portfolio efficiency score of 100. For reference, anything between 70 and 100 is considered to be efficient for today's market.
Yeah, we know that if volatility picks up, that means correlations are getting higher. That's a bear market characteristic. And since volatility's picked up in the stock market, one of the ways that we offset that and maintain consistent volatility in a portfolio is by adding securities that are not directly connected to the stock market. Whether that's international or sectors or industries, we can begin to add some of the alternatives. And one of the things we did last week was to sell one of the index funds we had in the portfolio and bought an inverse, which moved in the opposite direction. So on Friday, when the market was down 2.6%, that inverse was up in the neighborhood of 2.6%. So that not only stabilized the portfolio, but it improved our benefit of diversification.
Yeah, and so now if we go to a chart of just the portfolio thermostat and the S&P 500, and again, we don't want to benchmark against the S&P 500, but we just want to show you for reference. We can see there's a couple points here that the S&P 500 has been, kind of a lot more volatile than the portfolio, and you can see kind of off that December bottom how the market shot straight up, whereas the portfolio, took the initial straight up shoot, but it kind of stabilized out to protect on the downside because I think the downside was a much more probable move at that point.
Yes, and one of the things that we want to be really very careful of when benchmarking versus a fixed index is that an index is not really broadly diversified. And sometimes an index will get hot and you'll see a run of maybe 6, 7, 8, 10% over a relatively short period of time. And the problem with that is that's a parabolic advance, and parabolic advances
all in the same way.
That is, they pull back. So you can look at your portfolio and say, wow, it's not really keeping up with the S&P 500 or whatever benchmark that you've identified. But those benchmarks don't change, and when they get parabolic, they just give it back. So an index has no way to protect against the kinds of decline that we saw Friday, and actually the market has been selling off for some time now.
Yeah, and so the portfolio thermostat through that time has actually been able to stabilize, take less of a drop, and kind of get most of some of the kickbacks that we've seen during this kind of transitional environment. And then if we even compare that to, small caps, well, small caps are way off their highs from, last October.
Right, they're about 15, 16% off, and that's another thing. It's when you begin to index, which index am I using? Well, the S&P 500 has been one of the stronger index, but if you look at large cap internationals, or you said small cap stocks, those are approaching bear market declines already at this point, which would be 20% or more.
And so that kind of sums up this week's Canterbury Market Update. If you have any questions, feel free to reach out to us, and we hope you have a great week.